What is up, everybody? Welcome back to another cryptocurrency news article. This article comes from Cointelegraph, and banks are still showing interest in digital assets and DeFi amid market chaos. That's right, traditional financial institutions continue to demonstrate use cases for digital asset support along with DeFi capabilities, despite the current market conditions. The cryptocurrency sector is the Wild West in comparison to traditional finance. Yet, a number of banks are still showing interest in digital assets and decentralized finance. This year, in particular, has been notable for banks exploring these digital assets. Most recently, JP Morgan demonstrated how DeFi can be used to improve cross border transactions. This came shortly after BNY Mellon, America's oldest bank, announcing its launch of digital asset custody platform, which allows select institutional clients to hold and transfer Bitcoin and Ethereum. The Clearinghouse, a United States banking association and payments company, stated on November 3rd that banks should be no less able to engage in digital asset related activities than non banks. Banks are aware of the potential. While banks continue to show interest in digital assets, BNY Mellon's 2022 survey of global institutional clients highlights increasing demand from institutions seeking access to digital assets through reputable custodians. According to the survey, almost all of the 271 institutional investors 91% are interested in investing in tokenized assets. The survey also found that most of these investors are using more than one custodian, with 35% conducting business with traditional incumbent players. The heightened demand from institutions seeking access to digital assets is one of the reasons why banks are showing interest in cryptocurrency and DeFi offerings. Bobby Zagoda, CEO of Bitstamp USA, a cryptocurrency exchange founded in 2011, told Cointelegraph that Bitstamp has received many inbound requests recently for their Bitstamp as a service offering, which allows fintechs and traditional financial institutions to give clients access to cryptocurrency. Last year's fintechs were asking Bitstamp about services to support cryptocurrency. This year, fintechs have been discussing the downsides of non-offering clients access to digital assets. Banks are waking up to the fact that there is a client demand to buy and sell crypto, and if people can't do this with their banks, they will go somewhere else, he said. Zagoda added that banks currently not looking to implement digital asset offerings will lose market share. Banks are realizing that they could be creating a customer retention problem if they don't come to the market with crypto offerings. To Zagoda's point, BNY Mellon's survey found that 65% of institutions are currently engaging with digital native platforms rather than traditional financial players. However, BNY Mellon's findings also indicate that 63% of surveyors would accept longer settlement times in order to transact with a highly rated traditional institution. Moreover, some industry experts believe that larger banks can advance their operations by implementing crypto and DeFi solutions. Colin Butler, global head of institutional capital at Ethereum Layer 2 network Polygon, told Cointelegraph that while the pilot trade conducted by JP Morgan and the Monetary Authority of Singapore was a milestone toward the adoption of decentralized solutions, it also demonstrates that these entities are testing to see if DeFi frameworks are beneficial. If the answer is yes, then it would allow them to significantly increase the efficiency of their operations, he said. Butler elaborated that Polygon's proof of stake blockchain ensured that the cross border transactions conducted between JP Morgan and the Monetary Authority of Singapore and other banking entities was fast, secure, and cost efficient as possible, he said. All of these elements are extremely important when it comes to DeFi adoption. The inherent efficiency of blockchain based solutions is what gives DeFi an advantage over traditional financial systems that have been built over the past decades. While they're still working, these frameworks are very rigid. The latest advancements in DeFi can help make the whole process of transacting significantly more efficient and convenient. Now, echoing Butler, Seamus Donahue, Chief Growth Officer at Medico, a digital asset custody provider for a major financial institution, told Cointelegraph that he believes all financial assets will eventually be represented on a distributed ledgers. As such, Donahue mentioned that there is a imperative to redesign the financial markets infrastructure. This is the reason why virtual all tier 1 banks are now investing in building new infrastructures, not for the currently bearish crypto markets, but for the much larger vision of how every asset will be represented and how value will be created and exchanged globally, he said. Donahue added that banks will eventually become the bridge for institutions seeking exposure to digital assets in DeFi. He explained that this is due to the fact that traditional financial institutions have consumers' trust, large balance sheets, and a network of market participants creating liquidity, along with a customer base with unmet needs. However, traditional financial institutions remain concerned about regulations. Matthias Schultz, head of client and tech solutions at SEBA Banks, a Swiss-based digital asset bank, told Cointelegraph that their traditional banks are hesitant to engage with digital assets due to the regulatory uncertainty. In order to solve this, Schultz noted that SEBA Bank, with its license by Swiss regulators, acts as a trust counterparty for institutions to engage with digital assets. This is why SEBA Bank has been able to partner with a number of major banks in 2022, including LGT Bank, the world's largest family owned private bank. And he said this is also important from a consumer's perspective, as finding from BNY Mellon's survey notes that investors are primarily concerned with digital custodians, legal, and regulatory frameworks. Now, will market chaos impact interest in digital assets and DeFi? Well, regulations aside, the recent turn of events with FTX, US, and Binance may impact how traditional financial institutions view digital assets. While it's too soon to understand the consequences of the debacle, Donahue mentioned that the FTX US and Binance shakeup could have a short term impact. It could shift bank strategies to skip cryptocurrency services and focus exclusively on digital securities more broadly, at least temporarily, he said. Eric Berman, a regulatory expert at Thomson Reuters, told Cointelegraph that he doesn't believe this event will hasten bank involvement in digital assets. Banking institutions have taken it slow with cryptocurrencies as it is. The FTX US and Binance situation probably underscores the banking sector that it has done the right thing in taking pragmatic approach. In any case, both Donahue and Berman are aware that this event demonstrates the need for further regulatory clarity before traditional financial institutions can innovate with digital assets. The recent negative industry events have emphasized the critical need for safe and compliant infrastructure, business practices, and regulatory oversight. So, if anything, the demand for asset services from the trusted institutions, such as regulated global banks, has only increased, said Donahue. It's also interesting to point out that BNY Mellon's survey examined how the Terra ecosystem collapsed and has impacted institutional investors. According to the report, 9% of institutional asset managers noted that Terra's collapse has not impacted their digital asset plan, while 50% reported taking a short term pause to reassess, noting they will likely continue soon. Now, regarding whether the bear market will impact banks' interest in digital assets, Butler explained that crypto markets is not much of a factor affecting banks, particularly when it comes to DeFi. For instance, he pointed out that JP Morgan used Polygon to conduct a live cross-currency transaction that involved tokenized Singapore dollars and Japanese yen deposits, along with simulations of tokenized government bonds. According to Butler, those assets have no correlation with crypto prices, he added. Essentially, financial institutions are looking for ways to tokenize traditional assets, and this could be anything from bonds and fiat currencies to real estate deeds and transact them digitally. As such, these tokens retain the value of their original asset, so this is more about the technology itself rather than crypto prices in a bear/bull market. So there you have it. So yeah, it really doesn't like the thing going on with FTX and like prices of crypto don't really phase these institutions at all because they understand the larger role of it. They understand the opportunity. And if they don't get involved, they will get left behind. And they understand that if they don't offer these services, people will just go somewhere else. So, yeah, so very great article here. Kind of a little bit long. I hope you guys stuck around with it. But no, this just shows you like crypto's not dead. Blockchain's not dead. It's these guys are looking forward to it and they will continue on. So I hope you guys enjoyed the article. Hit that thumbs up button for me. Also subscribe. And until next time, the Crypto Sherpa is out.